Today is the inflation story overcooked, the DFA daily to the 12th of August 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. In today's show, we look at the latest US inflation numbers, local household and business confidence numbers, which appear to be in freefall, and why we need macroprudential tightening in Australian mortgage lending right now. But first, the S&P 500 and Dow notched record highs again on Wednesday as investor optimism over the economy continues to grow at a time when inflation is showing signs of peaking, and lawmakers on Capitol Hill continue to make progress on plans to boost infrastructure spending. The S&P 500 rose 0.3% to a new all-time closing high of 4,447. The Dow Jones Industrial Average rose 0.6% to close at a new record of 35,484, but the Nasdaq was down just 0.2%. The US Consumer Price Index rose 0.5% in July as expected, ending a string of 4 straight monthly upside surprises. On an annualized basis, consumer prices rose 5.4% in July, which is slightly higher than expected. Still, the sign of the cooling price pressures has eased fears of runaway inflation. For now, the streak of outsized inflation surprises is over, Jeffries said. However, it remains to be seen whether the period of elevated price pressure is truly over. The Labour Department reported Wednesday that its consumer price index rose 5.4% in July from a year earlier, in line with the June's figure, and that matches the largest jump since August 2008. The CPI increased by 0.5% on a month-over-month basis, and that matches the consensus forecast from economists beforehand. One of the most cited inflation gauges, the Consumer Price Index, measures changes in how much American consumers pay for everyday goods and services, including groceries, gasoline, clothes, restaurant meals, haircuts, concerts, and automobiles. Price measures of food, energy, shelter, and new vehicles all contributed to the July gain. Airfares and auto insurance costs declined. The CPI and other price measures have been on the rise in 2021, in large part thanks to a comeback in consumer spending and US gross domestic product as COVID restrictions eased. So-called core inflation, which excludes energy and food, rose by 0.3% last month, which is shy of the forecast 0.4% and well below June's rise of 0.9%. The core inflation is up 4.3% over the last year. That's a slight deacceleration from June's 4.5%. Economists often consider core CPI to be a more reliable indicator, since it's insulated from the frequent swings in petroleum and food prices. Shelter costs, which are seen as a more structural component of the CPI and make up about a third of the overall index, increased 0.4% and accounted for more than half the monthly gain in the core index. The rent index rose 0.2% as owners' equivalent rent, a gauge of price appreciation for purchased homes, climbed 0.3%. While rents and home values have jumped recently, it takes time for the price shifts to feed into the official inflation measures. The cost of lodging away from home, which includes hotel stays, continued to soar, rising 6% in July. Sharp decelerations in inflation in selected areas of the economy that had seen rapid price increases in the spring helped keep the headline numbers in check. Used cars and truck prices, which had risen rapidly between April and June as Americans looked to vacations, gained just 0.2% in July after a climb of more than 10% in the prior month. Apparel prices were flat after a 0.7% increase in June, and transportation service prices actually declined after a significant rise of more than 1% at the end of the second quarter. The Federal Reserve has been keeping a close eye on inflation reports since it's the central bank's job to maximise employment and keep prices stable. Jerome Powell and other officials acknowledged the recent acceleration in prices but believe that the inflation is transitory and that prices won't continue to increase at their current pace for too long. Today's CPI should help assuage investor fears that the Fed is too laid back about inflation pressures, wrote Shima Shah, chief strategist at Principal Global Investors. The details of the data release suggest some easing in the reopening and supply shortage-driven boost in prices, and tentatively suggest that inflation may have peaked. Investors in the transitory camp will feel slightly vindicated. The Fed has kept interest rates near zero for the past 12 months and continues to flush financial markets with $120 billion in emergency monthly bond purchases. Some members of the central bank, including Vice Chair Richard Clarida, have started to give forecasts for eventual interest rate increases. Economic activity, as measured by GDP, rose at an annualized rate of 6.5% in the second quarter as Americans flocked to restaurants, headed for summer vacations and otherwise resumed activities that COVID-19 had hindered. Consumer spending, bolstered by the nationwide rollout of vaccines, jumped 11.8% during the 3 months ending the 30th of June. That's the second fastest rate since 1952. At the same time, the pent-up demand for travel, retail and restaurants has left many businesses scrambling to keep up and led to several hiccups on the supply side of the US economy. Employers who have struggled to find workers have hiked pay or offered signing bonuses to help fill the record 10.1 million job openings across the economy at the end of June. The leisure and hospitality sector, which includes restaurants, bars and hotels, has one of the highest levels of job openings of more than 1.6 million. But instead of absorbing higher labour and material costs, some businesses have begun to pass on the impact of higher wages to their consumers. A concurrent shortage of semiconductors has whacked auto production and is a leading cause in a recent spike in new and used automobile prices. A New York Fed survey released on Monday showed consumers' inflation expectations over the next year are at a record high, while expectations for the medium term rose to an 8-year high. The path of inflation in the coming months has policy implications both for the Fed in terms of its timeline for reducing monetary support as well as President Joe Biden. Persistent inflation may make it harder for Biden to win unified Democratic support for another $3.5 trillion in social spending after the trillions of dollars of fiscal relief already injected into the economy since the start of the pandemic. Biden touted the report as evidence that inflation is slowing, saying the July CPI report showed reopening sensitive categories moderating in importance, posting the weakest contribution to the month-over-month gains since March. Services categories will take the baton over time, evident in our views that rents, a third of the CPI, will look sturdier over the second half. Many companies have increased or plan to increase consumer prices to offset higher material and production costs, including Colgate-Palmolive, Procter & Gamble and Kimberly-Clark. While wages have strengthened in recent months, higher consumer prices are eroding Americans' buying power. Inflation-adjusted average hourly earnings declines 0.1% in July after a 0.5% drop in the month earlier. That's, of course, relating to separate data also released on Wednesday. US Treasury yields retreated from highs following the inflation report and suffered a further fall on signs of strong demand for the US bonds. The $41 billion auction of 10-year Treasury notes on Wednesday was well received, with a bid-to-cover ratio that was the highest since May 2020, pointing to strong demand for the benchmark index at a time when other sovereign bonds continue to yield negative returns. Fall in yields didn't stop the ascent in banking stocks, which have been steadily ranking up gains recently. Citigroup, Wells Fargo and Bank of America were all up by more than 1%, pushing the broader financial sector higher. Sentiment on stocks was also given a lift following further progress on the $1 trillion infrastructure bill, which aims to improve the nation's transportation, internet access and other projects. The Senate has also passed a resolution to move towards that $3.5 trillion proposal, which is focusing on human infrastructure, including healthcare and education. Both bills have now moved to the House, but the fate of the smaller bipartisan infrastructure bill will depend on the successful passage of the $3.5 trillion package. House Speaker Nancy Pelosi has suggested that the $3.5 trillion bill will need to be passed before the House will vote on the infrastructure bill. Energy stocks bounced from a session low, building on a jump from a day earlier as oil prices advanced after the White House called on OPEC and its allies to boost production to support the global economic recovery. Petroleum data on Wednesday showed current crude stockpiles fell less than expected. US crude inventories fell by 448,000 barrels in the week to August the 6th. But there is a little sign of reprieve for tech stocks, with the mega-cap stocks mostly under pressure. Microsoft and Apple did trade higher, but Facebook, Amazon, Google parent Alphabet were all in the red. Tech has lost some favour with investors recently as seemingly high-valued sectors like growth tend to come under pressure in rising rate environments. With expectations of choppy trading for the broader market ahead, some are suggesting that investors with heavy exposures to tech stocks should move to the Dow Industrial Average instead. One actionable idea may be for those investors heavily weighted in tech to consider allocating some funds over to the Dow Jones Industrial Average, said Dan Wakrasti, Associate Director of Research at Janney Montgomery Scott. Now, back here in Australia, the Westpac Melbourne Institute Index of Consumer Sentiment fell 4.4% to 104.1 in August from 108.8 in July. At 104.1, the index is now at its lowest point in a year, but it's still well above the deepest negative lows seen during last year's national lockdown when it got to 75.6, and Victoria's second wave restrictions when it got to 79.5. The index is also comfortably above the readings seen over the 12 months prior to the pandemic, where it averaged 97.5. The virus situation locally is clearly troubling, but consumers appear reasonably confident that it will come back under control and that once it does, the economy will see a return to robust growth. The availability of effective COVID vaccines is a key source of support for confidence. Notably, sentiment is much stronger amongst those that have either been vaccinated or plan to get the jab. This group accounts for 76% of all respondents and has a combined sentiment read of 10 points above those not willing to get vaccinated, who have yet to decide. The gap is literally the difference between optimism and pessimism, in index terms 106.6 versus 95.9, and is apparent across all age groups. Virus developments at the state level were again a prominent feature in the latest month. Victorians recorded the biggest sentiment fall in August. Last month's reopening euphoria proved short-lived. The return to lockdown knocked the state's index back 10.8%, reversing most of July's 15% gain. The prolonged Delta lockdown continues to take its toll on New South Wales consumers' mood too. The extended, intensified and widened restrictions took a further 4.1% of confidence in New South Wales. The state index is now down 14.8% from its May high, but is still in slight positive territory at 101. Queenslanders were also jolted by a snap lockdown announced in late July, sentiment falling 4% to 103. That said, the hit looks to have been cushioned by official news that Brisbane will host the 2032 Olympics. The state's economy next 5 years sub-index posted a solid 7.1% gain, running strongly against the grain of a 3.2% decline across the rest of Australia. Notably, sentiment posted solid gains in the other major states, up 4.1% in Western Australia and 9.1% in South Australia, again in contrast to the virus shocks last year, which saw major spillovers from states at the epicentre of outbreaks in other jurisdictions. The NAB Business Survey was also gloomy. The survey continues to show widespread impacts of lockdowns. Both conditions and confidence deteriorated sharply in the month, with the latter now back in negative territory. Unsurprisingly, due to its size and severity of the lockdown in the state, New South Wales drove much of the result this month. Both confidence and conditions fell sharply following a full month of lockdown in the state. That said, conditions fell in all mainland states, with South Australia in particular also seeing a very large fall. Conditions softened in all industries, with the exception of mining, where it remains elevated. The forward-looking indicators also softened, and with forward orders now back in negative territory and capacity utilisation now back around average, there's little improvement in the conditions in the near term. Overall, the survey shows that the strength in the business sector seen in early to mid-2021 has faded on the back of fresh disruptions in the economy, but has not yet deteriorated to the lows seen in early 2020. With the survey showing very strong momentum in the head-up to the recent lockdowns, the hope is that once restrictions are eased, the economy will rebound relatively quickly, consistent with the experience through the pandemic to date, and resume a strong growth trajectory and a return to strong capex and employment plans. But to my mind, a double-dip recession does seem more likely now, and death of 1,000 cuts is hitting the small business sector particularly. New home sales are falling across Australia as the government stimulus has eased. The lockdowns bite. New home sales fell by 20.5% in July, with declines experienced in almost all major states, said HIA economist Tom Devitt. With lockdowns in multiple states restricting trade and eroding confidence, it's not surprising that fewer people were able to visit display homes, added Devitt. Despite this poor result in July, sales for the 3 months to the end of July are only marginally lower than at the same time in 2020, when the first positive impacts of home builder were emerging. Sales for the 3 months also remained 4.3% higher than at the same time in 2018, which was a relatively solid year for home building. This solid level of sales following the end of home builders suggests that demand for detached housing remains robust despite the poor result in July. Low interest rates and changes in consumer preference for location of housing has been the major drivers for activity following the end of home builder. Sales data over coming months will indicate if recent lockdowns have impaired consumer confidence or if this July result is just an anomaly. And no, we do not need a home builder too, but this is something I suspect, given past government action to support the construction sector despite the rising material costs, the absence of traders, and the rising costs of constructing a new home. In fact, many contracts allow for variation based on material cost rises, and many who signed up are now facing significantly higher prices and longer delays, thus ending up with bigger than expected mortgages. Local firms reliant on buoyancy in the property market are getting twitchy, judging by this from REA's Cameron Cusher. The firm, by the way, which recently reported booming profits on the back of recent mortgage lending and home price rises. He says, while prices have risen rapidly since the onset of the pandemic, growth has been much more benign over recent years, having increased by 33.2% in total, with 19.7% of that 33.2% growth occurring over the past 12 months alone. In this context, price growth over recent years in Australia has not been particularly strong. Right across the world, property prices are increasing rapidly. A deterioration in lending standards is something both the RBA and APRA are watching closely for, but says it's not something they're currently seeing. This is not to say a rapid run-up in prices is particularly desired, because it only benefits those who own properties. However, nor does it mean that regulators should at this stage step in and put a stop to those price rises, especially if there is no sign of deteriorating lending standards. While calls for macroprudential intervention will continue to grow as prices continue to rise, the RBA and APRA should resist those calls for the time being, unless, of course, there is a meaningful deterioration in lending standards. This isn't to say the RBA and APRA shouldn't continue to closely monitor lending standards. However, it would be a mistake to introduce macroprudential policies too soon just because property prices are rising rapidly, as this could lead to a slowdown in the domestic economy's performance. So, talking your own book there, Cameron. Sorry, curbs need to be in place now. Not least, remember that, as we discussed a couple of days ago, despite the public assurance from APRA that all is well on lending standards, at the very time they were supporting a rollback in responsible lending rules, APRA was writing to banks privately, asking them to proactively tighten standards. And next, we're already seeing a rise in new lending, including for investment purposes, and this data is, of course, delayed by a couple of months, so expect more growth. Third, the most recent APRA series revealed a significant deterioration in lending standards has already happened, with more interest-only loans, higher loan-to-income and debt-to-income loans, and higher loan-to-value. So even APRA's data confirms the deterioration which has already happened. Fourth, home prices are still booming higher, with movements which are unstable and dangerous. Look over at New Zealand, where they have now started to take steps to cool price growth, and where the Reserve Bank there is now required significantly and specifically to consider the impact of their monetary policy on home price movements. And fifth, the household debt ratios are turning higher again as incomes are under pressure while mortgage lifts. The average first-time buyer mortgage is 15% bigger than a year ago, and you certainly can't say that of average income growth. And sixth, household financial pressures continue to rise, as discussed in my recent live stream on household stress. With the economic slowdown now underway, thanks to the lockdown, APRA needs to get on the front foot and tighten controls, though I have to say I'm not holding my breath, as APRA and the RBA are frankly completely captured. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.